right. Welcome, and thank you all for being here today. Thank you for joining today. I'm very excited to be back, and based on popular demand, the topic I'll cover today is probably one of the most controversial topics in commercial real estate, and multifamily falls in that realm: cap rates. But before we dive in, while we're kicking things off, um, first of all, welcome again for those of you who are joining. Type in where you are dialing in from, or logging in or watching from. Would love to connect with you. And for those of you who don't know me, my name is Vessi Kapulian. I'm a former commercial lender turned real estate investor. Today, I am actively investing in apartments. And I also help investors who are new to apartments or new to multifamily learn how to effectively and efficiently analyze deals from beginning to end, so they can minimize the risk of loss and do that even if they have never underwritten a deal before. Oh, hi, Tammy. Great to see you. Glad that you could join us. And so, what I'll do is I'll try to cover as much as possible. It's an in-depth topic, and we can probably be here for hours. I do cover that in more detail in the course that I teach, Mastering Multifamily Underwriting.com, and you can see that site here on the screen. So, if you would like more information, you can simply go to the site or connect with me and via DM I can share more information with you, or answer any questions that you have related to today's live event. So, as we dive in, type win in the chat if you're new to multifamily, looking to get your first, maybe second deal done, and you want to learn how to analyze deals for success. So, type win in the chat. That also helps me connect with you better and answer any of your questions as well. But again, you can also DM in, and I'll happily have one-on-one discussions. So, without further ado, let's go ahead and get started. And I'll first begin by defining what cap rate is. That's basically the rate of return on a real estate investment property that is based on the income that such property is generating or is expected to generate, and if it was purchased all cash. In other words, it removes the element of debt. Why? Because that's a baseline to compare properties that may have, for example, different financing structures. So it levels out the playing field. Now, is this the only key performance indicator? Is this the only metric to look at when evaluating apartments? Of course not. It is one of many to consider, but it is an important one, and there are a lot of questions around it, which is why I decided to do a whole live event factor focused on it. So, as you think about the cap rate being the unlevered rate of return, in other words, the rate of return that the property generates if it was purchased all cash, then as you think about the return, there are different factors that impact the cap rates. Those could be the underlying economic conditions, interest rates, demand and or supply for apartments, the asset class, the location, the building age and condition. All of that impact cap rates. Now, you may think, well, the higher the cap rate, the better the property or the better the return. Well, not necessarily, because as you think about these various risk factors, right, the higher the cap rate, that also means the risk profile of the property is higher. So, for example, right, if I was looking at an older property in a tertiary market, I would expect that to have a higher cap rate, right? In multifamily, maybe 7%, maybe 8% in today's environment, versus a newer property, brand new build located in a a primary market that could have maybe 4% cap rate. Does it mean that one is better than the other? Not necessarily. Of course, you will typically need to do full analysis, but it does indicate the fact that that older property that has more deferred maintenance that's required in a tertiary market that may or may not have strong fundamentals comes with a higher risk profile. And so the unlevered return required for that property would be higher. Another example that comes to mind is a multifamily property, for example, compared to a different asset class like office or hotels, right? Those an office or a hotel would typically have a higher cap rate because it has a higher risk profile. So just because a cap rate is higher doesn't automatically mean that the property is better. Now, where do you find cap rates? That's a very frequently asked question. And there are a number of resources. I always recommend to people to consult multiple resources, not just rely on a single one. And so, CoStar reports, real page ERD reports would be one. Connecting with brokers, keeping a close eye or a pulse on your market, the market where you purchase properties in, connecting with fellow investors, being active in the market, real estate appraisals. They also have the will point out what the cap rate is. Oh, I see your message, Steve. I am not sure. Hopefully, can you guys hear me? I just want to make sure there are no audio problems. I just saw someone Steve typed in the chat. So hopefully that's not a problem for all of you. Maybe type yes in the chat if you can hear me fine. All right, I'll keep going. I don't see anything, and there's usually a bit of a delay between the comments, but if you can hear me, yes, please type in the chat. Okay. So we talked about what cap rates are, why they exist, how to evaluate. Okay, got it. Thanks, Steve. How to evaluate those, where to find them. I wanted to cover next what the different types of cap rates are, because that also typically creates confusion. And then I'll go through a live numerical example as well, so you can um, uh, maybe visualize this and make it a little bit easier to comprehend. So one is the entry cap rate, also known as the purchase price cap rate. And that's typically calculated by taking the actual in place net operating income of the property divided by the purchase price. So that would be the entry cap rate. There is the exit cap rate, which is calculated by taking the actual net operating income at the time of exit or the time of sale of the property divided by the sales price. And then there is the market cap rate, which is the cap rate as determined by um, by the marketplace at that time. And so let me actually bring up a live example and to show you how that is calculated. And I think it would be easier to see that on the screen. So give me one moment. Okay, so I'm getting messages that you guys can hear me. Okay, so that's good. Um, okay, so I will bring it up on the screen. Can you guys see the slides? Or it's really more of a visual calculation. Okay, so hopefully, maybe give me a yes or type in the comments. Okay, so hopefully you guys can see it. So I'll just share the screen. One moment again. I'll just enlarge it a little bit. And here it is. Okay, So we talked about the types of cap rate. So here is an example. We have a property with a purchase price of 2.5 million. The in-place net operating income or NOI is 120,000. So the cap rate at the time of purchase, or the actual cap rate, would be 4.8%, calculating by taking the 120,000 NOI and dividing it by the 2.5 million purchase price. Now, if we know the NOI and the market cap rate, we can figure out, well, what is that property approximately worth? So taking again the in-place NOI, let's just say it's 100,000. If the market cap rate at the time is 5%, then the property value would be 100,000 NOI divided by the 5% cap rate, or $2 million. So if someone was to come to you today, right, for try to sell you a property at $100,000 at a 5% cap rate, if you agree that this is really the market cap rate and you have supportable data, that may not be an unreasonable ask, right? But if the market cap rate is 6%, as in the example below, that same property, right, at $100,000 NOI divided by 6% would be worth 1.67 million. And if someone comes to you asking for 2 million, right, that may be too much, right? There are, of course, a lot of other factors that go into determining the price of the property, and we're not going to be covering those today. But if you needed to do like a quick ballpark calculation on trying to determine what the value of the property is based on what you believe that cap rate is for that market, you can do so at that time. And let me just exit the screen. A moment. All right. Perfect. Oh, thank you guys. So glad that you could see it. So I'm glad that worked out. So we covered those concepts, and then one more thing that I wanted to touch base on is the concept of positive and negative leverage. Again, in the context of cap rates, typically what we're referring to as positive leverage is when the cap rate or the unlevered return of on the property exceeds the interest rate on the loan. And in that case, you're buying a property with a return that's higher than the cost of debt for the property. So if the cap rate is 6.5 and the interest rate on the loan is 5.5, that will be considered positive leverage. The inverse of that is negative leverage, right? When your interest rate on the loan is higher than the cap rate, which basically means the cost of capital, the cost of your debt, exceeds the return that this property would generate if it was bought all cash. So, in that hypothetical example, if your interest rate on the loan is 6.5 and your cap rate is 5.5, so I reverse the two numbers, then you're buying the property at negative leverage. And why that is important is, especially in the beginning when you're trying to do quick calculations and determine, is this property a good fit for me or not? If it's negative leverage, more likely than not, is not going to cash flow, in at least in the first year or maybe even year two of operations, depending on how the rest of the deal is structured. And if you're a cash flow investor, right, and if that's important to you, that will be something that you will need to take into consideration as you decide whether that's a yay or a nay when it comes to the deal. So I know I spoke a lot, and I will pause for a second while you're getting in the questions coming in the chat. I know that there is a bit of a delay between the stream yard and the different platforms. So while I wait for you guys to type those questions in the chat, I'll cover a couple that seem to be very frequently raised when it comes to cap rates. and they pertain to the idea of, are cap rates static? Do you adjust cap rates? What do you do with that information, Bessie, when you know what the market cap rate is and where you're buying the property at? And typically, when I model out future cash flows, I would like to um, make a conservative assumption and assume that the markets will get worse before they get better at the time of exit. And what that means from a modeling perspective is I would assume that at the time of exit, my cap rate will be higher versus lower. So when I model that in my pro forma cash flow, that's an assumption I would like to make. Not everyone would agree with me, but why that is important is because cap rates actually have a multiplier effect on the value of the property. We walked through the calculations a few minutes ago where I showed you how you take the NOI divided by cap rate to come up with the value of the property and vice versa. So you can think of it as almost an inverse multiplier effect that they have on your pro forma or future valuation. In other words, it's probably one of the metrics, the other one being rents, cap rate being the first one, that has the biggest impact on your exit valuation. And so if you don't get that right, right, if you get that wrong, you can be in for a very, very unpleasant surprise at the time of exit. So personally, I like to plan for the worst and hope for the best, right? And so in my modeling, I like to assume that the cap rates will increase at the time of exit versus decrease. Of course, if you assume cap rates will decrease, then you're basically inflating the exit valuation quite a bit. And the risk you're taking in that scenario is, what if the markets don't improve, right? What if the markets actually get worse, right? Then the exit valuation that you plan for will not happen, and you may have, in fact, even overpaid for the property if that's what you're expecting today. Um, Another question that comes up is, well, how do you know what the exit cap rate is? Well, you don't. Nobody knows where it will be, right? And you can look at CoStar reports, various data points. These are all projections, right? Nobody knows where rates would be, which is one factor that impacts cap rates, where markets, demand, and supply will be, which is another factor that impacts cap rates. Nobody knows. And that's why it's best to be conservative when you're making those estimates and assume that cap rates will be higher. Now, what a lot of people typically do, I guess, in a more stable environment is, or in an improving environment, is increase cap rates by 10 basis points every year for the duration of holding the asset. So if you're holding an asset for, say, 5 years, 10 basis points of a year would total up 50 basis points, so 0.5% increase in cap rates at the time of exit. But that is not a static number either, right? Because if you had asked me how I model my cap rates 2, 3 years ago when rates were extremely low and the Fed had started announcing their intent, and eventually they followed through with that intent to start increasing interest rates, well, I wasn't modeling 10 basis points, right? I was modeling 20, 25 basis points a year. If you were to ask me today, right, do I still model 20, 25 basis points a year of cap rate reversion or cap rate increase? The answer is no, because I tend to believe we're at the peak of the rate cycle. If anything, they've indicated they started reducing rates. There will be subsequent declines, and of course, it does take time for cap rates to catch up. There is a bit of a lag effect and lag factor. So today, to be conservative, I would look at, again, probably 10 basis points a year. Now I do see a question: is there a general when we've been increasing it by 5 year to be conservative? Yes, very very much so, Steve. So I appreciate you chiming in. So today I generally look at 10 basis points a year. Um, would I consider maybe a smaller spread, like 5 basis points? Absolutely, especially if it's a really strong asset in a really strong market. There and then I look at additional ancillary data points like the broker reports, etc., to support that. Um, that's not out of question either. So I always recommend take a look at, of course, take into consideration the particular asset, right? But also take a look at various market data points so you can reach a conclusion. Just a single report, right, is not always sufficient in my humble view. But yes, it's a question we often look to answer as investors, and I wish it was as clear cut as a mathematical formula, and the math is behind it is clear, but then there is also the art component, right? The science is clear, but the art of it is making that judgment call, and a lot of it is also tied to your personal outlook of where that particular market and sub-market will be, your personal outlook on where the overall markets, real estate markets, multifamily markets, the economy will be, and your personal risk tolerance, right? If you have aversion to risk, and if you're more conservative like I am, I would err on the side of caution, right? But just last week, I was presented with a deal, right, where they were buying it at a 5.7 cap. The market cap in that particular area is hovering around 6% today. So automatically for me, that's a no go. Like, why are you overpaying for an asset? Unless there is a big value add potential or a big upside. And in that case, there wasn't there was some rent upside, but it wasn't big enough. And not only that, their exit cap rate was, I think, 5.5, which they were basically reducing the exit um, from where it was today. And I'm not saying that's right. I'm not saying that's wrong. That's just not right for me. My outlook on where rates would be in the long run, and consequently where cap rates would be, is different. My risk tolerance is also different, so I prefer not to speculate. I prefer not to guess. Again, I'd like to plan for the downside. So that would be an example of a real life scenario that I encountered last week. That was a no go for me. But clearly, that particular investor had already made a decision, right? The property is already under contract. They're raising capital for it, so they had decided to move forward with it. That's based on their risk tolerance, their outlook on the market. So I think we're out of time. I really appreciate you guys joining today. Appreciate the engagement. Appreciate the questions. Again, if you'd like to connect with me, you can DM me. Also, if you'd like to be notified of future live events, you can follow me on LinkedIn as well as YouTube. I'll be doing these bi weekly with the goal of sharing my knowledge and real life experiences to help create educated and empowered investors, one live event at a time, one deal at a time. And of course, if you'd like to learn more about the course that I teach and how I help beginner investors in the space, you can either connect with me directly or go to masteringmultifamilyunderwriting.com. And I wish you a fabulous day. I'll see you at the next live. Ciao.